In the current situation, it's crucial to understand that the market is in a period where expecting high profits and significant movements is extremely difficult. Essentially, there is no trend right now, and the price is constantly changing direction. The fundamental background is not being considered by the market, and its participants are simply looking for a reason to sell the dollar. The last trading day of the week doesn't promise anything good. Reports on non-farm payrolls and unemployment will be published in the States, which can easily send the dollar into another steep dive. It doesn't take much for the American currency to fall right now. If non-farm payrolls comes in 10,000 below the forecast, that will be enough for the market to rush to sell the dollar again. The same goes for the unemployment rate. Any value above 4 will provoke a weakening of the American currency. It doesn't matter that unemployment in Europe is 1.5 times higher. It doesn't matter that the European economy showed a maximum growth of 0.3s over the last 6 quarters, while the minimum GDP growth in the US over the same period was 1.4. But according to the market, the American economy is on the verge of collapse, while everything is fine in Europe. The average volatility of the GBU's pair over the last 5 trading days is 64 points. For the pound-dollar pair, this value is considered average. On Friday, July 5, we thus expect movement within a range limited by levels 1.2696 and 1.2696 and 1.2820. The senior linear regression channel is pointing upwards, signaling the continuation of the upward trend. The CC indicator entered the overbought area this week and showed divergence on the last 2 highs. The GBUSD currency pair has once again consolidated above the moving average line and has been rising for the 2nd day in a row. After consolidating below the moving average line and breaking through the 1.2680, 1.2695 area, the chances for further decline of the pound increased, but the market is still in no hurry to sell. Traders should be cautious with any positions on the British currency. There is still no reason to buy it, and selling is dangerous because the market has refused to sell the pair for 2 months and continues to do so. From our point of view, only short positions can be considered relevant with targets at 1.2604 and 1.2573 if we are talking about a logical and consistent movement. However, the pound is not even able to properly correct downwards. The average volatility of the euro-USD currency pair over the last 5 trading days, as of July 5, is 49 points. Characterized as low, we expect the pair to move between levels 1.763 and 1.861 on Friday. The senior linear regression channel is pointing upwards, but the global downward trend remains. The CC indicator recently entered the oversold area, but it has already been worked out by an upward pullback. The euro-USD pair maintains a global downward trend and is located above the moving average on the 4-hour time frame. In previous reviews, we mentioned that we only expect the continuation of the downward trend. Currently, short positions remain relevant, but the correction may continue for some time. Unless, of course, it turns into a new upward trend. The 3rd consecutive bounce from the 1.681 level triggered another round of upward correction. We still do not consider buy orders, as we believe the global downward trend continues, and there are no reasons for the euro to rise, except for local ones. But the price may move north within the correction for some time, especially this week when most of the statistics from across the ocean were disappointing.